Imagine it's October 2001. You're a middle-class retiree in Buenos Aires. You did everything right. For 35 years, you worked at a manufacturing plant. You saved 20% of every paycheck. You avoided debt. You put your money in the bank, in government bonds, in a life insurance policy your father told you would protect your family. By November, the Argentine peso was still pegged to the US dollar. The government promised stability. The banks promised liquidity. Your financial advisor told you to stay calm. By December, the government froze every bank account in the country, a measure they called the corralito. You could not withdraw your own money. Within weeks, the peso was devalued by 70%. Your savings, your bonds, your insurance policy, all of it denominated in pesos, lost 2/3 of its purchasing power before you could react. The assets you thought were safe were the very instruments that destroyed you. You didn't make a mistake in execution. You made a mistake in assumption. You assumed the rules of the game would remain constant. And when the rules changed, your assets became the cost of someone else's solution. This is how currency resets work. They don't punish the reckless. They punish the trusting. This video isn't about Argentina. It's about pattern recognition. Because what happened in Buenos Aires has happened before. In Weimar Germany, in Zimbabwe, in Venezuela, in the Soviet Union, in Brazil, in Yugoslavia, in dozens of economies across recorded history. And the pattern is always the same. When governments reach a certain threshold of debt, when interest payments begin to consume revenue, when political systems become incapable of spending cuts or tax increases, there's only one exit: the currency adjusts. And when the currency adjusts, there are certain asset classes that absorb the loss. Not because they were bad investments, but because they were designed to fail in exactly this scenario. This isn't theory, it's documented history. Today, we are going to perform an autopsy, not on Argentina, not on Weimar, but on the asset classes themselves. We're going to examine 5 categories of holdings that, throughout monetary history, have consistently transferred wealth from their owners to the state during currency resets. I'm not going to tell you what to buy. I'm not going to give you investment advice. What I'm going to do is show you the mechanism, show you the history, and let you draw your own conclusions. Once you see the pattern, you cannot unsee it. Before we examine the assets, we need to understand the mechanism. Most people think of a currency reset as hyperinflation. Images of wheelbarrows of cash in Weimar Germany, $100 trillion bills in Zimbabwe. And yes, those are currency resets, but they are the extreme end of the spectrum. A currency reset is any event in which the relationship between a currency and real value is fundamentally restructured. Sometimes this happens through hyperinflation, sometimes through devaluation, sometimes through redenomination, sometimes through capital controls, sometimes through all of these simultaneously. The common element is this: assets denominated in the old system lose purchasing power relative to assets denominated in real things. Consider the Bretton Woods collapse in August 1971. President Nixon announced that the United States would no longer convert dollars to gold at the fixed rate of $35 per ounce. Within a decade, gold was trading at over $800 per ounce. That's not gold going up, that's the dollar going down. That was a reset. Not dramatic, not sudden, but irreversible. Consider France in 1960. Charles de Gaulle introduced the nouveau franc, replacing the old franc at a ratio of 100 to 1. The currency didn't collapse, but every asset denominated in old francs was administratively restructured overnight. Pensions, bonds, insurance policies, bank accounts, all of them converted at the stroke of a bureaucratic pen. Consider India in 2016. The government announced demonetization of 500 and 1,000 rupee notes. 86% of all currency in circulation was declared invalid with 4 hours' notice. The explicit goal was to destroy unaccounted wealth. Millions of people lost access to their own money. These are not anomalies. These are tools that governments have used repeatedly throughout history when fiscal mathematics become unsustainable. And in every case, there are asset classes that bear the cost, not randomly, by design. Let that sink in. Asset 1, long-term government bonds. The first asset class that consistently fails during currency resets is long-term government bonds. This seems counterintuitive. Government bonds are considered the safest asset class in traditional portfolio theory. They are backed by the full faith and credit of the sovereign. They are rated 8AA by credit agencies. They are the benchmark against which all other assets are measured. But there is a structural flaw in this reasoning, a flaw that only becomes visible when you understand what a government bond actually is. A government bond is a promise to pay a fixed amount of currency at a future date. The key word is fixed. The key word is currency. When a government cannot pay its debts in real terms, it has 3 options. Option 1, default, refuse to pay. This is politically catastrophic. Governments lose access to credit markets. Politicians lose elections. It almost never happens voluntarily. Option 2, austerity. Cut spending and raise taxes to generate the surplus needed to pay bondholders. This is also politically catastrophic. Citizens riot. Politicians lose elections. It rarely happens at the scale required. Option 3, inflate. Print the currency needed to pay the bonds at face value while reducing the purchasing power of that currency. This is politically invisible. Bondholders receive their promised dollars, but those dollars buy less, much less. This is why long-term government bonds are the first casualty of currency resets. They are the instrument through which governments transfer the cost of their debts from themselves to their creditors. The historical evidence is overwhelming. In Weimar Germany, government bondholders were wiped out entirely. Bonds that matured in 1923 were paid in marks that were worth less than the paper they were printed on. In the United States, between 1940 and 1980, holders of long-term treasury bonds lost over 70% of their purchasing power to inflation. They were paid in full, in nominal terms. In real terms, they were robbed. In Brazil during the 1980s and 1990s, bondholders experienced repeated currency reforms. The Cruzeiro, the Cruzado, the Cruzado Novo, the Cruzeiro Real, the Real. Each transition destroyed the purchasing power of fixed income instruments denominated in the previous currency. The mechanism is always the same. Governments do not default on their bonds. They redefine them. They pay you exactly what they promised, and what they promised becomes worthless. The longer the duration of the bond, the greater the exposure. A 30-year Treasury bond purchased today is a bet that the U.S. government will maintain the purchasing power of the dollar for 3 decades, a bet that inflation will remain contained, a bet that the fiscal trajectory will reverse. Look at the numbers. The U.S. national debt is now over $34 trillion. Interest payments alone exceeded $1 trillion in fiscal year 2024. The Congressional Budget Office projects that debt to GDP will reach 170% by 2054 under current law. These are not controversial figures. They are published by the government itself. The question is not whether this debt will be paid. It will be paid. The question is what those payments will be worth. This is where it breaks. Asset 2, cash and cash equivalents. The second asset class that fails during currency resets is cash itself. This is the most painful lesson because cash feels safe. Cash is liquid. Cash is what you reach for when you're uncertain. But cash is not wealth. Cash is a claim on wealth, and that claim can be diluted. There is a mathematical identity that governs all currencies. The total amount of currency in circulation divided by the total amount of goods and services in the economy equals the price level. If you increase the currency faster than you increase the goods, prices rise. This is not theory, it is arithmetic. Since 2008, the Federal Reserve's balance sheet has expanded from approximately $900 billion to nearly $8 trillion. That's not a typo. The monetary base increased by a factor of 8 in 16 years. Now, consumer price inflation did not increase by a factor of 8 during this period. And this is where the illusion of safety comes from. But the inflation appeared elsewhere. Asset prices, housing, equities, healthcare costs, education. The inflation was real. It was just distributed unevenly. During a currency reset, this distribution changes. The inflation that was previously absorbed by asset markets begins to flow into consumer prices. The excess currency that was parked in financial instruments begins to chase real goods. And cash, which has no yield, no hedge, no structural protection, absorbs the full impact. In Venezuela, citizens who held their savings in bolivars lost everything. Inflation reached 1,000,000% in 2018. A year's salary became worthless within weeks. The Venezuelans who survived financially were those who converted their bolívares into dollars, gold, or physical goods before the collapse accelerated. In Zimbabwe, the same pattern. Citizens who trusted the Zimbabwe dollar were destroyed. Citizens who converted to hard assets or foreign currencies preserved their purchasing power. In Argentina, during the 2001 crisis, bank deposits were frozen and then forcibly converted from dollars to pesos at an artificial exchange rate. Even those who thought they were holding dollars in Argentine banks discovered they were actually holding pesos. The government redefined their assets overnight. The lesson is structural. Cash is a political instrument. Its value is maintained by political will. And when political will fails, when fiscal mathematics overwhelm political capacity, cash becomes the mechanism through which wealth is transferred from citizens to the state. This does not mean cash is useless. Cash has optionality. Cash can be deployed. But cash as a long-term store of value has a documented failure rate of 100% across sufficiently long time horizons. Every currency in history has either collapsed, been reformed, or lost the majority of its purchasing power. The US dollar has lost over 96% of its purchasing power since the Federal Reserve was established in 1913. Not through crisis, through policy. Think about what that means. Asset 3. Annuities and fixed income insurance products. The third asset class that fails during currency resets is fixed income insurance products. Annuities, whole life policies with cash value, pension buyouts, any instrument that promises a fixed stream of currency payments over time. These products are marketed as safety, as guaranteed income, as protection against market volatility. And in nominal terms, they often deliver exactly what they promise. The insurance company pays the stated amount on the stated schedule, but the value of that payment is not guaranteed. Only the number is guaranteed. An annuity is structurally similar to a long-term government bond, except with an additional layer of counterparty risk. You give a lump sum to an insurance company today. They promise to pay you a fixed monthly amount for the rest of your life. If inflation runs at 3%, your payment loses half its purchasing power in 24 years. If inflation runs at 7%, your payment loses half its purchasing power in 10 years. If inflation runs at 15%, you are impoverished within a decade. The insurance company is not cheating you. They're paying exactly what they promised. But the currency in which they pay has been redefined beneath your feet. This is not speculation. This is historical record. In Germany after World War I, life insurance policies that were purchased in stable marks became worthless in hyperinflated marks. Families who had spent decades paying premiums received payouts that could not buy a loaf of bread. In Hungary in 1946, the pengo collapsed so rapidly that prices doubled every 15 hours. Insurance policies, pensions, fixed annuities, all of them evaporated. Not through default, through arithmetic. In Poland, during the 1980s, pensioners who had contributed their entire working lives to state pension systems found their monthly payments worth less than a day's groceries. The mechanism is identical in every case. Fixed income instruments are denominated in currency. Currency is controlled by the state. When the state faces fiscal impossibility, the value of the currency is sacrificed before the state itself is sacrificed. This is not corruption. This is survival. From the perspective of the state, allowing inflation to erode fixed income promises is politically preferable to explicit default or explicit taxation. The beneficiaries of these products are typically elderly, dispersed, and politically weak. They are the path of least resistance, and so they pay the price. In the United States today, the insurance industry holds approximately $8 trillion in assets backing these types of products. $8 trillion in promises denominated in dollars, promises that will be kept in nominal terms. The question is what those dollars will buy. Asset 4, certain categories of real estate. The fourth asset class that fails during currency resets is, perhaps surprisingly, certain categories of real estate. Now, this requires nuance. Real estate is a real asset. It exists in physical space. It cannot be printed. And throughout history, real estate has often served as a store of value during currency crises, but not all real estate, and not under all circumstances. The distinguishing factor is debt. Real estate owned free and clear behaves very differently during a currency reset than real estate encumbered by fixed-rate debt. But there is another category that performs worse than both. Real estate that generates income denominated in the collapsing currency while carrying operating costs that rise with inflation. Consider commercial real estate during the stagflation of the 1970s. Landlords with long-term leases locked in rental rates denominated in dollars. As inflation accelerated, their rental income remained fixed while their property taxes, maintenance costs, and utilities rose. Their real returns collapsed. Many were forced to sell at distressed prices. Consider residential rental properties in countries experiencing capital controls. When governments restrict the movement of money, property values collapse because buyers cannot access financing or foreign currency. Argentina's real estate market fell by more than 50% in dollar terms during the 2001 crisis, not because the buildings disappeared, but because the pool of buyers evaporated. Consider luxury properties and vacation homes. These are the first assets liquidated when wealth is destroyed or frozen. They have high carrying costs, limited utility, and depend entirely on discretionary income. During currency crises, they become unsellable at any price. The real estate that survives currency resets is productive property. Farmland, properties that generate income in essential goods or services, properties in jurisdictions with stable rule of law, properties owned outright or financed with fixed-rate debt in the inflating currency. The last point deserves emphasis. If you hold a 30-year fixed-rate mortgage denominated in dollars, and the dollar loses 70% of its purchasing power, your debt has effectively been reduced by 70% in real terms. The bank is paid in full, in nominal terms. But you have transferred wealth from the bank to yourself through the same mechanism that destroyed the bondholder. This is not advice. This is physics. The same force that destroys the lender benefits the borrower. The same force that destroys the cash holder benefits the asset holder. But only if the asset is the right type. Only if the jurisdiction maintains property rights. Only if capital controls do not prevent liquidation or transfer. These are not small caveats. In every currency crisis, governments have imposed restrictions on property transactions. In Cyprus, in 2013, capital controls prevented citizens from moving money out of the banking system. In Venezuela, property transactions and bolívares became meaningless because no one would accept the currency. Real estate is not inherently safe. Real estate in the wrong form, in the wrong jurisdiction, with the wrong financing structure, can be as destructive as any bond or annuity. The mechanism must be understood before the asset can be evaluated. Asset 5. Retirement accounts with trapped capital. The fifth asset class that fails during currency resets is retirement accounts with restricted liquidity, tax-advantaged accounts, pensions, 401ks, IRAs, any vehicle where capital cannot be accessed without penalty, delay, or government permission. This is the most uncomfortable category to discuss, because these are the accounts most Americans depend on. These are the accounts people have spent decades funding, and these are the accounts where the structural vulnerability is least understood. The vulnerability is not the assets held within the account, it is the account structure itself. When capital is trapped, when you cannot access your own money without a 10% penalty, when you must wait until age 59 and a half, when distributions are taxed as ordinary income, you have ceded optionality to the state. You have agreed to play by rules that the state can change, and states have changed these rules repeatedly throughout history. In Hungary in 2010, the government effectively nationalized private pension funds. Citizens were given a choice: transfer your private pension assets to the state system or lose your state pension benefits entirely. 97% of Hungarian pension holders transferred their assets. Over 10 billion euros moved from private hands to government control. In Poland in 2013, the government seized approximately half of private pension fund assets, specifically those invested in government bonds, and transferred them to the state social security system. The justification was debt reduction. The result was that citizens lost direct ownership of assets they had accumulated over decades. In Argentina in 2008, the government nationalized 10 private pension funds worth approximately $30 billion. The assets were absorbed into the state system. Private account holders became dependent on government promises rather than segregated investments. In Ireland, during the financial crisis, the government imposed a levy on private pension funds to help finance the bank bailout. Citizens who thought their retirement assets were protected discovered that the protection was contingent on government need. These are not theoretical risks, these are documented events. In modern, developed economies, within the last 15 years, the United States has not nationalized retirement accounts, but the structural prerequisites exist. The Social Security Trust Fund holds approximately $2.8 trillion in Treasury securities. These are not external assets. They are claims on future tax revenue. When the trust fund is exhausted, currently projected for 2033, benefits will either be reduced, taxes will be raised, or the difference will be printed. And private retirement accounts represent an enormous pool of captive capital. Over $35 trillion in U.S. retirement assets. Capital that cannot flee, capital that can be taxed, capital that can be regulated, capital that can, if political necessity demands, be redirected. I'm not predicting this will happen. I'm observing that the structure permits it. And throughout history, what structures permit, crises eventually demand. The constraint is optionality. When you cannot move your capital, you cannot respond to changing conditions. You become a fixed target, and fixed targets pay the price. These 5 asset classes, long-term government bonds, cash, fixed annuities, vulnerable real estate, and trapped retirement capital, share a common characteristic. They are all promises denominated in currency. They are all dependent on institutional continuity. They are all designed under the assumption that the rules will remain stable, and they all fail when the rules change. The mechanism beneath all of these failures is the same. It is the mechanism of impossible mathematics meeting political reality. Governments make promises. Pension promises, healthcare promises, defense promises, infrastructure promises. These promises accumulate over decades. They compound. They become politically untouchable. Eventually, the promises exceed the capacity to fulfill them through taxation or borrowing at sustainable interest rates. At this point, there are only 3 options. Option 1, break the promises explicitly, cut benefits, reduce services, default on bonds. This destroys political careers and frequently governments. Option 2, raise taxes explicitly, take more from the productive economy to fulfill the promises. This destroys economic growth and frequently governments. Option 3, break the promises implicitly, fulfill them in nominal terms while reducing their real value. Pay every dollar promised while ensuring those dollars buy less. This is invisible. This is deniable. This is politically survivable. Option 3 is always chosen. Not because politicians are evil, because option 3 is the only option that does not immediately destroy the decision makers. And option 3 falls disproportionately on holders of fixed income assets, on retirees, on savers, On those who trusted the rules, that's the trap. If these asset classes absorb the cost, who captures the benefit? This is where the autopsy becomes uncomfortable, because the answer is systematic. Those who benefit are those who hold assets that adjust with inflation. Equities in essential industries, commodities, productive real estate, foreign-denominated assets, debt that erodes in real terms. Those who benefit are those who understand the mechanism before it accelerates. Those with access to information. Those with access to mobility. Those with access to assets that are not trapped in fixed structures. Those who benefit are, overwhelmingly, those who already have wealth. Because wealth can be restructured, wealth can be moved, wealth can hire advisors who understand these mechanisms. The middle class is disproportionately concentrated in the asset classes that fail: savings accounts, government bonds held through retirement funds, annuities sold by insurance agents, houses purchased with 30 years of payments. This is not conspiracy. This is structure. The middle class holds these assets because they were told these assets were safe, because safety was defined as low volatility, because low volatility in a stable system looked like wealth preservation. But volatility and risk are not the same thing. Low volatility assets can carry catastrophic risk. A government bond does not fluctuate day to day, but over decades it can lose everything to forces that never appeared on any statement. The wealthy understand this, or at least their advisors do. The wealthy hold productive assets. They hold businesses. They hold equities. They hold tangible resources. They hold optionality. The middle class holds promises. And when the system must choose between breaking promises to the many or restructuring assets of the few, the math is clear. There are more middle class voters, but middle class assets are easier to dilute. The reset is not neutral. The reset has distributional consequences. And those consequences are determined by asset structure. Every element of this pattern is currently in motion. U.S. federal debt exceeds 120% of GDP. Interest payments exceed defense spending. The Congressional Budget Office projects permanent deficits regardless of economic conditions. The Federal Reserve holds nearly $5 trillion in Treasury securities. This is monetized debt, debt that was created by the government and purchased by the central bank with newly created currency. Social Security and Medicare face combined unfunded liabilities exceeding $170 trillion in present value terms. These are promises that cannot be kept in real terms. They will be kept in nominal terms. The average American retirement account is dominated by domestic equities and bonds denominated in dollars. There is minimal international diversification. There is minimal commodity exposure. There is minimal protection against dollar devaluation. The average American holds the majority of liquid wealth in bank deposits and money market funds, instruments that yield less than inflation, instruments that are already losing purchasing power in real time. I am not predicting a date. I'm not predicting a trigger. I'm observing that the structural prerequisites for a currency reset are present, and that the asset classes most widely held by the American middle class are precisely those that have failed in every historical precedent. This is not pessimism. This is pattern recognition. The purpose of this analysis is not to create fear. Fear is not useful. Fear leads to paralysis, and paralysis is exactly what the structure depends upon. The purpose is to illuminate the mechanism, to show you the game board, to demonstrate that what feels safe is often what is most exposed, and that safety in a changing system comes not from avoiding volatility, but from understanding structural risk. The question you must ask yourself is not, will there be a reset? Resets happen. They have happened repeatedly throughout history. They will happen again. The question is only timing and magnitude. The question you must ask is, where is my wealth positioned on the game board? Are you holding promises or productive assets? Are you holding currency or claims on real things? Are you holding trapped capital or optionality? Are you positioned to absorb the cost or to adjust when the rules change? These are not investment questions. These are structural questions, and they can only be answered by understanding the mechanism. This video is historical and educational analysis. It is not financial advice. It is not a recommendation to buy or sell any asset. Every individual situation is different. Consult qualified professionals before making any financial decisions. What I have presented here is the documented record of how currency resets have functioned throughout history. What you do with this information is your responsibility. In 1923, German citizens who had spent their entire lives saving, working, and accumulating marks discovered that their entire net worth could not buy a week's groceries. In 2001, Argentine citizens who had trusted their banks, their government, and their financial advisors discovered that trust was not a hedge. In 2008, Icelandic citizens who had deposited their savings in the nation's 3 largest banks discovered that deposit insurance is only as strong as the sovereign that guarantees it. In 2013, Cypriot citizens who had deposited over 100,000 euros in their banks discovered that deposits could be confiscated overnight to bail out a banking system. These are not ancient history, these are modern events in developed economies. with educated populations, with sophisticated financial systems. The pattern is consistent. The mechanism is consistent. The asset classes that fail are consistent. The question is not whether this happens. It happens, repeatedly, documentably. The question is whether it happens while you are holding the wrong assets. History does not repeat, but it rhymes with uncomfortable precision. The pattern is already in motion. If this analysis was useful, consider subscribing. This channel exists to study the mechanisms that most financial education ignores, to perform autopsies on systems before they fail, to illuminate patterns that become visible only in hindsight, unless you learn to see them in advance. Most people will never study these patterns until the cost has already been paid. The few who understand the mechanism have the opportunity to position themselves accordingly, not with panic, not with fear, with clarity. The next video will continue this work.